Welcome everyone to today's Mutant Meetup call. We've been holding these for the last several weeks at 9 a.m. Eastern, 1 p.m. UTC. Quite a few things to go over today. I know they say that every week, but there are actually several pretty large announcements to go over. The first one is that the deposit has been made in Maple Finance, so I'll do a review of all of the aspects of that. We're using an Enzyme vault to manage the funds that are deposited in the Maven 11 wETH lending pool. Talk a little bit about Chainlink proof of reserve, go over some questions that I've seen about the Nexus Tracker and some discrepancies there. And then I'll just do a quick review of our current capital pool investments. Hugh is going to provide his weekly core team update. I'll go over the standard cover sales for the last week and active coverage by cover type. I'll also talk briefly about the Chainalysis mid-year crypto update. I read through this. It's a really great resource, so I just wanted to touch on some of their findings about hacks so far this year. And then I'll provide some community updates. I'll talk about Claim 121, which is for Bancor V3 that's up for a full member vote at the moment. I'll talk about the ETH proof of work snapshot vote and next steps. We talked about this last week, but there's been further discussion on this. And then I will provide an overview of Tip 121, which is the proposal regarding Tribe DAO. Within there, they have a discussion about what they're doing with the Fuse hack repayment and other things as well. But that'll be what we touch on there. So I'll get started, and I will go over the deposit that was made in Maple Finance. So this was up for votes last week, and or the week previous, and this was passed by members in Proposal 172. We talked about this on previous calls, but now that this deposit is made, I wanted to provide some more information, talk about the components that are in here. I'll also be updating the Nexus Mutual documentation and the Nexus Financial section so that people can read that and just add that to the history of the investment allocations we've made over time. But with this one really crucial component is that we needed to have an Enzyme vault to manage some of the assets from the capital pool so we could deposit those into Maple Finance. This is something that we worked on with our engineering team, and they worked with the folks at Enzyme. We were able to get this integration so that we can have this vault where we can manage different capital pool investments. This was first used for the Maple Finance allocation, but this is something we can use in the future as well. There's transparent reporting. You can find a link for this in the thread for today's call as well. In here, it goes over where the allocations are, what the NAV is for those assets in Maple Finance. It gives some very nice breakdowns of the different sections. And then it shows us the Nexus Mutual treasury tokens, which are held in the capital pool. And those represent our position. So with this, we have other opportunities that we can do to allocate investment earnings over time through this Enzyme vault. This is another component that we're looking at for the stake-wise allocation, which is covered on the forum as well. There's some technical elements that we need to sort out for that to move forward as well. But one of the important things with capital pool investments is every new token added to the capital pool increases the gas costs and makes it a lot more complex. So having something like the Enzyme vault where there is one token that's added to the capital pool where we can manage a variety of different investments, this is like a really big step forward for us and presents a lot of opportunities in the future to increase our investment allocations within that risk framework that Nexus Investment has laid out, and you can find on the forum as well. But one important component of any investment allocation from the capital pool is how we actually track the price of those assets. Because we have assets that are managed through this Enzyme vault, we need to be able to track the price per share of those assets. So that's deployed into Maple Finance and is held in the Enzyme vault. We have the Nexus Mutual Treasury Yield tokens, and to make sure that we can have that price information that's coming back to the capital model so we can make sure that the NXM token is priced correctly, that capitalization is represented correctly within the mutual, since so much of that depends on the underwriting process for risk assessment and other factors. We need to have reliable price feeds. We use Chainlink for a lot of our existing price sources, And we worked with them with proof of reserve to have this price feed that allows us to verify the amount of lending pool tokens and the value of those tokens in our Enzyme vault. With this, we can automatically track and report the value of those assets that we have deposited in Maple Finance. As investment earnings accrue, that'll be reflected in the vault, and then that pricing information will be reflected in the capital pool. That price per share of the Nexus Mutual Treasury Yield tokens is reported, and this is a really crucial component as this price feed is required for the capital model and really for any investment allocation that we make over time. We'll be working with Chainlink on an announcement that'll go out later today, so look for that. But I wanted to cover some of this as well, since Chainlink proof of reserve is something that is utilized by several different organizations within DeFi and some people that are doing investments or managing funds that are off-chain. So this is a really important aspect of this investment allocation, and it's also another great use case of Chainlink and how we're working together with them to secure the mutual and to have reliable price feeds. Just an update on that allocation to Maven 11 and the wETH lending pool on Maple Finance. So since we deposited, there's been 4 new loans that have been issued. Again, we deposited 15,358 ETH in the pool in total. And since we made this, there's been 16,000 wETH loans originated. All of them currently have 90-day maturities. So the APY now, if you look in the Maple Finance app, is 5.3%, with 1.23% in Maple APY and 4.2% in lending APY. All of that, like I talked about last week, you can find that in the Maple Finance app. All of the information on loan history, on pool stats, all of that info can be found in their application as well. But like I said, since we actually deposited, there's been 4 loans already that have been issued. So it's very exciting. Pretty much as soon as we put that capital in, there were people that were looking to borrow, and over time, this will help us add more investment earnings to the capital pool. And we've had some questions in Discord about some of the elements in Nexus Tracker. So right now, it's not reporting the correct information because that proof of reserve price feed isn't being reflected in the Nexus Tracker. This is something that will have the person who created the Dune dashboard that we use with the Nexus Tracker, we'll have them update that to reflect those prices for the token and the assets in the capital pool. So if you look in the actual Nexus D app, you'll see that the price is still correct there. And if you look in the Nexus Tracker, there's a discrepancy in the price. So I've had some questions about this. The capital is still in the capital pool. It should reflect about 153,552 ETH, and the price should be around, it's 0.0321 ETH, but whatever the price is of that this morning, when I put this together last night, it was $50.65 per NXM. So that will be updated. So everything else in the Nexus Tracker is reliable. Some of this information related to that price feed needs to be updated. So no worries there. Everything you can verify directly in the actual D app itself. And then I just wanted to go over the current capital pool holdings and the investment allocations, given what I just mentioned. So if you look at the capital pool address on Etherscan, you can see the Lido ST ETH allocation, which is a little bit more than 20%. So that's 31,168 ST ETH. Primarily, the capital pool is held in native ETH, so that is still liquid. That's up just about 70%. And then 10%, which was the capital pool allocation to the Maple wETH lending pool. There's also a very small amount in DAI that's held in the pool. We have an integration so we can swap to DAI to meet obligations as claims queue up, as claim events happen. So that's still something we can diversify into. That's something we can talk about later too in the ETH proof of work proposal, but I'll talk about that a little later. You can look in the Nexus financial section of the docs, and you can see the investment allocation history. I'll update that later today with the Maple allocation now that I have this information. And you can also find information in there about the Nexus Capital Pool and the Nexus Treasury. All of that information is also in that section in the docs. So just wanted to give everyone an idea of what we actually have in the capital pool, what the investment allocations are, and there's actually in the next financial section the link to the Lido STETH rewards calculator. So you can plug in the mutual's address and see how much we've earned to date in STETH. So I will hand things off to Hugh to give his weekly core team update. Hugh?
Cool. Thanks, Lee. Hey, everyone. Yeah, a couple of things from my side this week. As I said, there was a lot of work from the engineering team on getting the Maple stuff all coordinated between Enzyme and Chainlink, etc. So I'm glad that that's all got over the line. Now, I guess the other kind of main focus is obviously right now on V2. So heavy focus on the UI at the moment. We're building the cover by process right now, and I guess the other one is we're just ramping up all the testing and stuff that continues on. So now we've got the investment allocation kind of out of the way. That's kind of one bigger distraction that will free up that's kind of we're past now, so that'll free up the team to focus more on V2. So all things going well on that front. We're just kind of working through it. I guess the other there's kind of a few other things wanted to just cover. Just going back to my notes, sorry. We're also having a look at the custody cover claims. So I guess we're expecting some claims in a little while on Celsius and likely on Hodlnaut, depending on how things go. So we're kind of doing some background work there just to make sure we can get the information and maybe see if we can help the claims processes, especially via iTrust, which is the integration with Hodlnaut. And so we're just making sure that the flows and stuff work fine on that side of things. The other thing is we've been talking to the bootnode team. They've kind of come up with a spec on the covered vault, and so we're just kind of reviewing what they've come up with, making sure it makes sense from an integration perspective and incentive structure perspective and all that type of thing. So that's there's a decent amount of work there as well. So those are probably the main things on the engineering side. More on the kind of research side, we continue to be progressing the tokenomics stuff. It's definitely kind of research stuff side, and there's a few kind of implementation options that we want to do that we're looking at and doing some different modeling on. I think just to kind of recap for others that may not have kind of had an update on this one in a little while, the main aim is to I guess there's quite a few aims, but one of the bigger aims is to allow some exits of NXM from the mutual at up to book value under certain conditions, as long as we've got enough money to pay claims. And so that's kind of one key. There's a few kind of technical mechanisms that we're looking at to do that, and we're kind of doing some modeling work to see which one makes most sense and that. So it's progressing nicely, but it's still a bit of a research phase at the moment. Though we've got some good input from the engineering teams in terms of what's viable from a technical point of view. Because there's one challenging problem, and that's kind of making sure that we can calculate on chain the full active cover amount across everything, and that's kind of hard to do from a gas point of view or technical point of view. So we're looking at some options there. So that's kind of the tokenomics side. I guess quite a few other things, like especially on the BD side, with we're talking to a lot of different players on the staking side of things after the Stakewise deal went ahead. They take a bit longer, but lots of people, others are quite interested. And I guess we're also talking about things like I guess post-tornado cash sanctions, what that might look like, and slashing risk and those types of things, and does it change things, etc. So there's quite a lot going on that side as well. The other thing I did want to raise, which I might not get to this week, but I'm going to aim to get to next week, if not, is I think it makes sense for us to potentially review the protocol cover wording, in particular the economic incentives, the economic design failure aspect. I think we've had a little bit more experience over the past, I guess, 18 months or maybe 2 years on the new wording, and I think it's definitely one thing's clear to me is that it's not clear exactly when event qualifies or not for that definition, and so I think it's worthwhile kind of tightening that up in some respects and clarifying exactly what we mean. And I think there's multiple options there, but I think it's worthwhile having a bit of a review of that wording. So I'm going to put some thoughts out on that, and hopefully I'm interested in others' opinions on that as well. So no, there's a few other things to talk about, and Lee's got some good topics on the ETH proof of work and the Tribe Rari proposals and stuff. So yeah, might chime back in once we get to those. Cool. Yeah, happy to take questions on any of that.
Okay, if there aren't any questions at this time, I'm going to move on and do a review of the cover sales from the last week. You can find all of the information here in the Nexus Tracker. So in the last week, we sold a little bit more than 15.1 million in covers. The largest covers that we sold were for Convex Finance, Vector, and Alchemix V2. We also saw a couple sizable cover buys for MStable and Aave V2. This brought in just about $60,000 in premiums in the last week. We also saw a scattering of cover buys for the ETH 2.0 deposit contracts, FTX, Badger DAO, Beefy Kraken, and Cream V1. Some very small amounts for some of the other cover buys. But looking at the denomination of the cover buys for the last week, primarily DAI denominated for the most part for cover sold, with about 90% in DAI denomination and about 10% in ETH denomination. But we see that the premiums that are coming in are about an even split of 50-50 between DAI and ETH. I'll also go over the active coverage by cover type. I find this helpful to review just to see where liabilities are. I also include this in the newsletter just because I think it's good to get a sense of where our active coverage is across the different cover types. So for active protocol cover policies, we have just about 104,000 ETH, and this is roughly 162.3 million in active coverage. Some of our larger covers, like the one that we had for Enzyme, have now expired. So the leading protocol cover active coverage is for Convex Finance. Behind that is Anchor, Curve, some of these standards that we see a lot for. Liquidity also has a sizable amount of active coverage. Aave V2, Yeti Finance, Angle, Gnosis Safe, and DYDX Perpetual. Some of these are the leading protocols with active coverage week over week. And then things kind of taper off from there with MStable, Uniswap V3. Another place to look at active protocol cover is with our Immunify bug bounty matching program. So I update that every week as well for the white hats that are active and looking for bounties to review within the Immunify community. So you can look at that. That's also available in the docs, but you can also find this information on the Nexus Tracker. Custody cover policies, we've seen a little bit of a drop in active coverage. So 23,347 ETH in active cover and about 36.45 million in active coverage. FTX, Yield App, and Nexo represent the largest active coverage, with Crypto.com, Holdernot, and BlockFi leading off from there, and then things taper down from there. Like Hugh said, we're anticipating claims coming in for Celsius and Holdernot, but the Celsius claims will be eligible for filing on 12th of September, and Holdernot claims can be filed on the 7th of November. This is assuming that withdrawals are halted past that 90-day period, which those are the dates when it'd be the 91st day for each. Active yield token cover, about 2,104 ETH or 3.28 million. Yearn YV Curve ST ETH is still the largest active coverage for yield token cover, like we saw last week. Origin OUSD is behind that. We've seen convex MIM curve kind of going down in active coverage over the past month. And then ETH2 staking cover policies, still the same as it was previous week. So 5,348 ETH across those two stake-wise ETH2 staking cover policies. So that's about $8.5 million as of yesterday. And then I wanted to touch on the Chainalysis mid-year crypto crime update. So you can find this report. I have a link to this in the thread for today's call as well. They have a lot of insights in there about the prevalence of scams in crypto, about activity on the darknet, and then they talk about cryptocurrency stolen in hacks versus last year up until this year at the end of July. So there's a lot of interesting information. While scams primarily are down, we're seeing that hacks are actually higher at this point this year than they were last year. A lot of the largest hacks that we've seen so far have targeted bridges, but 1.9 billion worth of cryptocurrency stolen in hacks through the end of July this year. This doesn't include things like the Nomad bridge exploit that occurred in August, or the Solana wallets issue that happened where I believe it was the Slope wallet that had the seed phrases stored in plain text, and there was a vulnerability there where somebody was able to get that information and basically withdraw assets from a variety of different wallets. So a lot of these hacks are growing in size, even though the price of ETH and other assets are down. In this report, they talked about the impact of North Korean state-sponsored hacking groups. So out of this 1.9 billion worth of cryptocurrency stolen in hacks, 1 billion is represented by North Korean-sponsored agencies. Another really interesting insight, but we are seeing hacks continue to go up. And like they say in here, I have a quote from them, that we shouldn't really expect theft to drop, because wherever there are large amounts of funds, people are going to try and steal them. This is why regular audits and bug bounties are so important, but also, like we've talked about previously with bridges, if a bridge is secured by a multi-sig that has a low threshold for signers through standard phishing or malware, those private keys can be compromised, and that can lead to some very large losses. We saw that as the case with the Axie Infinity Bridge, the Ronin Bridge that was exploited earlier this year. We saw that as the same thing for the Harmony Bridge that was exploited as well. And then things like the Nomad Bridge or the Wormhole Bridge that were exploited, those were due to flaws in the code where somebody was able to pass a message through or mint assets on one side and redeem them on the other side, leaving a lot of those synthetic assets unbacked. So highly recommend everybody checking this out. I think it kind of informs what we're looking at as far as risk for protocol cover. Once I think I have some more insights there, I'll share some of my thoughts in the risk assessment channel. And then I'll move on to some of the community updates. So one of the announcements that we made was that there was another Bancor V3 claim that was filed, so claim 121. I made an announcement in the claims discussions channel. This was eligible for voting for a 3-day period for all members who wanted to stake and act as claims assessors. Because that quorum threshold wasn't met, now it's eligible for all members. This is going to close today at around 3:11 p.m. EST, according to the time in the app, because 72 hours. This first went up on the 20th of August at same time. So the leading outcome for this is denied. Like I had mentioned, and I know that Gordon is on the call as well, he provided his view on why the claim should not be accepted as well. Looking at the cover wording, it doesn't meet that 20% loss requirement. So that is one reason why, based on the wording, that it is looking like it's going to be denied. That being said, it's important for everyone to vote on this. People can still vote one way or the other. So if you want to participate in this, there are resources in the announcement about how to participate in claims assessment. It's open for all members, so if you want to participate, you can. But in this instant, it's important that members discuss this. I appreciate Gordon sharing his thoughts. And as a general note, too, until Nexus V2 launches, we're not going to be able to pay partial claims, as it's a technical hold up on our end. So when claims assessors vote, they're deciding yes or no on votes. And until V2 launches, where we have the functionality to actually pay partial claims, that 20% loss requirement is integral so that we're not overpaying for losses. This is something that's been live since protocol cover wording. We've talked about this previously in other claim events, but it's an important thing to note as well. So look for any further discussions in the claims discussions channel on this, but by tomorrow we should know what the outcome is. But currently leading outcome is to deny. On the forum, there's also a link in the thread for today's call, but further discussion and next steps on what action we could potentially take with the on-chain vote regarding ETH proof of work. So we've talked about this on previous calls, and the two things at this stage, now that it's passed a temperature check, with most people supporting the sale of proof of work assets when the hard fork happens, or I should say if it happens. I think it's pretty likely to happen. So how are we going to do this? We've talked previously that we'd have to capture this value on a centralized exchange, which means that we'd have to have some third party who is a trusted member, likely somebody from the advisory board or somebody who is a multi-sig signer on the Nexus treasury address, to execute this trade for us on the centralized exchange. And then the other question is, what should we do with the proceeds if we decide to sell? So there's been a few comments on the forum about this. I've shared my thoughts, which would be reserving some of the value for buying back WNXM and reserving some of the value for adding DAI to the capital pool. My thought is that WNXM can be held in the community fund, whereas the DAI would be held in the capital pool to better match our assets and liabilities over time. I know that Gordon is on the call and Gauthier is on the call as well. First, I'd like to hear from Gauthier. I have his most recent comment, which was posted this morning on here. So, Gauthier, if you'd like to talk about the discussion that the Nexus Investment Advisory Group had, that would be great.
Hey, can you hear me?
Yes, I can.
Cool. Yeah, so as we've discussed on the previous calls, there is some details to decide on, and the next vote will be about how do we convert the proceeds of liquidating the proof of work assets. Some member have commented on the forum. As for now, the consensus seems to be a 50-50 split between buying WNXM and sending them to the community fund, and keeping DAI for the capital pool. And yeah, I've gathered some feedback from the investment committee that I posted on the forum earlier today, which goes in the same direction, I'd say. So I think if nobody has like other opinions in the next few days, it will likely go for a vote, snapshot vote soon, so we can keep the process going.
Yeah, I definitely agree. I think at this point, there's still time, I think probably till the end of the week for further discussion. And then next week, we can kind of take some of the options that are presented on the forum and then put those up for a final snapshot vote just to solidify what the leading outcome that members would like to see. And at that point, we can progress to an on-chain vote where we would vote on this and it would be a yes or no vote. Yes to allocate, or no to not allocate, according to the decision that we achieved from that snapshot vote. So this is just a way to signal sentiment among members and then have things ready for that snapshot vote so that once that decision is made, we're confident that that is the way to move forward and to capture value from ETH proof of work. Gordon, I know that you're on the call. Would you like to share some of your comments on the forum as well?
Yeah, thank you for the invitation. I think my comment makes it clear. The point is this: there's no such thing as free money. Everything carries risks. And in this case, the risk has to do with American securities regulations and the fact that the war between the American legal system, the governmental regulation of crypto tokens, and shall we say the VCs who back a lot of the American companies who dominate, including they dominate Ethereum validation, etc. This war is a war. It is highly unpredictable. And so I would like to highlight to everybody that this is not free money. Money comes with a contingent risk that we get tagged for securities fraud as sellers. I can't tell you what the probability is, but I can tell you that the penalty, if we do get tagged, is severe. And you have seen this play out in the Tornado Cash situation. It is clear that American regulators overreached the American Constitution in banning the software protocol itself. However, it will take a long time to reverse that, sort that, and in my view, people who've been tagged will end up having to do full KYC and expose everything just to recover. This is a war. It is not fought fairly. And so the risk is significant in my view. And we need to think about that in our execution as well. Are we really committing securities fraud if we do this? And that's the, in essence, that's my point. If this turns out to be not very much money and the risk turns out to be as substantial as I think, it ain't worth it. If it turns out to be a hell of a lot of money and we get away with it because we're a UK mutual and we can tell the SEC and American courts to fuck off, yeah, why not? But it ain't free.
Cool. Yeah, cool. I mean, thanks for your comments. Just one question from me on this. What in your mind makes this fork different to the ETC fork?
Yeah, that's a really good question. Time. The ETC fork happened before anyone in America cared. This one, not so much. In fact, there are people trying to divert a big chunk of the Uniswap treasury to actually bring an action for securities fraud against the people promoting proof of work. This is to advance all sorts of legal and regulatory agendas. But I think the answer, Hugh, is timing. I think if you ask me, if you look at my Twitter feed, you'll see I'm a consistent critic and warner of anybody who plays with ETC. I think that Robinhood should be sued for listing ETC. I think that one of the reasons they will bring actions against ETH PoW is to get ETC before it does more damage. And just because these cases are so easy for the SEC to win. SEC are lawyers. They're evaluated based on how many cases they win. If you have a choice between prosecuting Vitalik for launching ETH, prosecuting whoever's been selling ETC on Robinhood, and prosecuting people trying to sell ETH PoW, I can tell you which one they're going to prosecute for free. They're not required to be consistent. They're not required to do anything except scare the shit out of people with easy to win cases. That's the way they work.
Cool. Yeah, appreciate your comments. I can't really comment on that. I'm not a lawyer. I don't have an opinion one way or another on this.
No, I mean, I think the takeaway is it's not risk-free. If we're going to do it, better be worth it, and we better do it in a way that protects us from being complicit in securities fraud. It may be that just delegating an independent third party who has a North Korean passport is good enough.
I definitely agree that nothing is risk-free. In fact, one of the things I think that has happened within DeFi in the last couple of years has been the use of the word risk-free, because there's not a single thing in life that's risk-free. I definitely appreciate your comments, Gordon. Definitely appreciate you commenting on both posts on the forum. I think it's definitely for something that members can consider. However, I will say that there's no North Korean person. I know that was a cheeky joke, but that can actually KYC to centralized exchange. I think there's definitely risks. I know we've talked about some of those in previous weeks. One of them is the risk of replay attacks if the chain ID isn't dissimilar, or if the chain ID is the same between the two. I am also not a lawyer. I think that this is something that is somewhat tricky. We do know that there are quite a few people within the space that are borrowing ETH ahead of proof of work to try and capitalize on that. I think it's really going to be up to whatever markets actually offer any liquidity, which is likely going to be centralized exchanges. But which ones, I think at this point, is somewhat unclear. So definitely one of the things that members should consider when voting. Again, we'll basically get the consensus on what the leading direction is that people want to pursue. And at the end of the day, this is up to members to decide. And when that goes to an on-chain vote, people can always vote no. And if the leading outcome is no for the on-chain vote, then this won't be pursued, and that'll be the end of it. So, but I do think that's definitely an important consideration, and I appreciate you for sharing that.
Thank you for the invite. Also, Hugh, I just wanted to mention, you know how I feel about Bancor. I hope that the rewording of economic failure will take that case into account.
Yeah, that's probably one of the intentions. I think one of my big intentions of the protocol cover wording review is to make sure that we're not exposing the mutual to like just blanket kind of market risk stuff. So
yeah. I mean, the bottom line,
that's the general idea.
Yeah, the bottom line is when you have two discretionary actions on either side of a transaction, and market conditions are volatile, we can't just assume that we're always there to ensure an outcome where somebody loses, because there was discretion on both sides and volatile market conditions in between. No one suffered an involuntary loss. Everything was voluntary, and that's important.
Yeah, I do see your point on that one.
And when that discussion starts about protocol cover wording, I'll definitely cover that in another call, and that'll be on the forum as well. That'll be something that I think is really important as well, because we definitely want to make sure that cover wording is clear, and we don't want to open ourselves up to too much risk, because we always want to make sure that we can pay claims. We want to make sure that we can protect people in the longer term as well. But given some time, I'm going to move on to the next slide, which is the proposal for the future of Tribe DAO, the TIP 121 that is active in the Tribe forum. So there's a proposal that's talking about essentially unwinding the Tribe DAO. This would allow people to redeem FEI for $1 or 1 DAI. But the important aspect here for members of the mutual is that fuse hack victims would receive payments, making most victims whole. Now, there's some conditions here. It depends what the asset backing of Tribe is when they allow people to redeem Tribe for underlying assets. But assuming that there are favorable conditions, right now, if you look at the forum post and the fuse hack repayment numbers, the addresses for members who received claim payouts for the Rary Fuse exploit those are labeled as Nexus addresses. So for those addresses, we should be receiving the tribe if this does go through. And then that tribe can be distributed to members who acted as risk assessors and had their NXM burned to facilitate that claim payout. In their accounting, the sum total of bad debt owned by those Nexus label addresses is about 1.14 million. And there's a couple of different ways that we could do this, either redeeming the assets and buying WNXM to then distribute, or just allowing people that have been burned to receive the tribe and then redeem that for underlying assets themselves and choose what they'd like to do. But either way, I think this is a net positive. I think that this proposal has other issues that many people on Twitter have talked about, but this specific element I think is important because with this, like we've talked about before, partial payments are not possible. We have the language in the cover wording. This will be addressed once V2 launches, but in the interim, any compensation that the community fund receives for these loss events where risk assessors are burned can be then redistributed to risk assessors to offset some of those losses from having their NXM burned. So this is really important. I think everybody should review that. And hopefully, once this proposal is discussed within their community and it goes up for vote, it passes in maybe a better form than it is now, and then we can actually compensate some of those risk assessors who are burned to facilitate these claim payouts. So really optimistic on this. I'm hoping that everything works out, but we all know that things in DeFi are never certain. So definitely something to watch. And as updates happen here, I'll be sure to let everybody know on our community calls as well.
I think, sorry.
No, go ahead.
Well, I just wanted to say that whether we're talking about the excess payout in Rary, about the shall we call it questionable payout on Bancor, or this this problem with Faye and Tribe, the issue is this: insurance is based on the idea of spreading the cost widely. The Nexus plan with these dedicated pools, it has a tendency to concentrate risk within the mutual. And I just think first of all, the claims assessment process, I think the thought process needs to be segregated in the sense that I think we should be using special masters to establish the fact. I mean, this is all the way it works in real insurance. Special masters establish the facts. Then the next question that we should be asking is, okay, we're discretionary, but do we want to spread the cost of this widely or narrowly? And I know there were technical constraints, but I think the philosophy should be, in the case of something like Rary, we're going to do it, but we're going to spread that cost widely across the whole, not concentrated on a pool. Same story with Bancor. We may decide that maybe we didn't make the right decision on Bancor. We're going to spread that cost. We're going to socialize that cost. And why is this important? Well, we saw in Rary that any time you have a vote where people who are paying out are on one side and people who are unscathed are on the other, the vote will always fail. But this is very short-sighted for the simple reason that the mutual will win or lose based on attracting more capital. If we don't attract more capital, our money will be locked in there forever. The demand will always exceed the size of the pools. And the only way to attract more capital is to preserve the track record of future syndicate managers and others. And the only way to do that is occasionally to take some of these borderline edge cases and socialize the cost to save the track record of the people who are in the pools, okay? I personally have been staking over 30 projects for over a year and work full-time in DeFi. I kind of know what I'm doing, maybe midwit. My aggregate payouts exceed my aggregate rewards. Maybe I'm dumb. But the point is, there's no way that you're going to attract capital into the pool and unlock everybody's money someday with those kinds of track records. So occasionally, for marketing, PR, and other reasons, we can exercise our discretion to make a payout. But to dump all that on just a few pool stakers is very short-sighted. You can never, the syndicate managers can never recover from one of those. And that it cripples their ability to attract future capital.
Yes, I think that's a fair point. Again, I think with what's coming in V2 is that we'll have the functionality for partial claims. So losses are going to be reflected in claim payouts. There's not going to be disproportionate payouts that don't actually represent the actual losses. Within the syndicate model itself, when people are voting on claim outcomes, that is going to be reflected across whatever syndicate is underwriting that risk. It's very similar to what we have today. It's just that we allow people with expertise to manage risk and determine staking allocations. But also, I think a key to having trust to attract capital is sharing your view of risk over time. So having transparency on what you're staking against, having some rationale on what you think is risky. And at the end of the day, if people are delegating capital to things, and the risk ends up being larger than the potential rewards, then that's just going to naturally happen, which is why we need more expertise in the claims assessment and risk assessment process. I think we've already seen that there is a tendency for people with expertise to vote and participate in claims assessment. Not everybody may agree on claim outcomes, but I think that's why it's important for people to participate. I think the majority of the claims that have been paid out are not very controversial. I know that you're not a fan of the Bancor claim payout, but I think that's one claim payout in probably all of the others that are non-controversial. So,
yeah, I might just Lee, I might just jump in there because I think there's a couple of points that Gordon raised that are very valid. One is the fact that I take the point that the losses are more concentrated when you have a syndicate model, and I think that's fine in general because you want to align interests and you need them to have skin in the game, and so they're going to be setting the pricing as well. So you need them to have the ability to set prices and take losses. So I think that's quite important. But the second point is that if we do have grey discretionary claims where we decide to pay, then I guess your argument about that should be socialised more widely and perhaps you just pay from the pool but don't burn anyone, then to me that does seem generally quite logical. However, I think the better solution there is to actually have tighter wording so that the discretion comes in, I guess, quite infrequently. V2 is not designed specifically to, I guess, classify a claim between full genuine or discretionary. It's just a yes or a no. And however, there are always manual upgrade type functions that could effectively decline a claim and then make a just one-off payment out of the capital pool to a particular address in lieu of the claim. So you could do that without burning it. But I think what we need to do is, what Lee said, attract specialist claims assessors, which I think the model is set up to do and is relatively doing now. Clarify cover wordings as much as possible to remove the grey cases, because I think that's ultimately where a lot of the challenges lie. And perhaps as a third one, in a future upgrade, allow this ability for kind of, I call it, discretionary payments or ex-gratia payments, I call it, that don't burn us. Anyway, yeah, but no, the valid points and worth taking on board.
Okay. Other than that discussion point, or if anybody else wants to comment on that, at this time it's an open forum. So if there's anything that I didn't talk about, anything we didn't touch on that anyone would like to bring up or ask questions about, feel free to do that now. If not, I can wrap things up for today. Thank you, everybody, for joining us. I know we had quite a bit in terms of updates. I really appreciate everybody who spoke, Gautier and Gordon, for contributing your thoughts. I'll have that announcement for the capital pool allocation out later this morning around 11 a.m. Eastern. So we'll be pushing that across the different social channels. I'll have an announcement in Discord and on Twitter when that is live. I will talk to everybody next week on the call. I hope everyone has a great rest of their day and a wonderful rest of their week.